Hi everyone, welcome to my investing podcast. Today, we dive deep into the world of finance and investment. I'm your host, Rocky, and today we'll be talking about two key financial ratios that investors use to evaluate companies: the PE ratio and the PEG ratio. Whether you are a beginner investor or looking to brush up on your financial knowledge, this episode is for you. Let's start with the PE ratio, or the price to earnings ratio. This is one of the most commonly used metrics for valuing a company. But what exactly does it mean? The PE ratio is calculated by dividing the stock price of a company by its earnings per share, EPS. So if a company has a stock price of $50 and an earning per share of $5, the PE ratio would be 10. Why is this important? A higher PE ratio can indicate that investors are willing to pay more for the company's earnings, often because they expect high growth in the future. On the flip side, lower PE ratio might suggest that the stock is undervalued or the company is experiencing difficulties. PE ratios can be tricky, especially when comparing companies in different industries. A PE of 20 for a tech stock might not mean the same as a PE of 20 for a utility company. So it's crucial to consider the industry average when interpreting the PE ratio. Now, let's take a look at three big companies to better understand the PE ratios in action. As you can see on my screen, we've got three companies: Apple, Tesla, and Coca-Cola. As of recent data, Apple's PE ratio is around 28. This high ratio reflects the fact that Apple is a dominant player in the tech industry with consistent earnings growth and strong investor confidence. Investors are willing to pay a premium for its earnings, believing that Apple will continue to perform well in the future. Secondly, we look at Tesla. Tesla has a much higher PE ratio, around 50 or more. This suggests that investors are expecting even higher growth from Tesla, giving its focus on electrical vehicles and energy innovation. Investors are willing to pay a premium for Tesla's earning. The company will revolutionize the auto and energy industries. Thirdly, we look at Coca-Cola. Coke, on the other hand, has a much lower PE ratio of around 20. While still a solid performer, Coca-Cola is a more mature company with slower growth prospects compared to tech growth companies like Apple and Tesla. Investors typically pay less for its earnings, reflecting its stable but slower growth. So, PE ratio takeaways. When you compare these companies, make sure to compare with their individual 5-year average and industry averages for each company. Let's dive into the PEG ratio, or the price to earnings growth ratio. This is essentially a refinement of the PE ratio and gives you a sense of whether a stock's valuation is supported by its expected earnings growth. The PEG ratio is calculated by dividing the PE ratio by the annual earnings growth rate. So if a company has a PE ratio of 20 and its earnings are expected to grow by 10% annually, the PEG ratio would be 2. A PEG ratio of 1 is considered fairly valued because it suggests the stock price is growing in line with its earnings growth. A PEG ratio greater than 1 might indicate that a stock is overvalued relative to its growth prospects, while a PEG under 1 could point to a stock that is undervalued given its growth rate. Now, let's continue with our examples. First, we look at Apple. Apple's PE ratio is 28 and its expected earnings growth rate is around 7%. To calculate the PEG ratio, we divide the PE ratio by the growth rate, 28 divided by 7, which gives PEG of 4. This suggests that Apple might be slightly overvalued based on its expected growth, but investors are still willing to pay a premium because of the company's track record of innovation and stability. Secondly, we look at Tesla. Tesla's PE ratio is around 50 and its expected growth rate is around 35%. Dividing the PE ratio by the growth rate is equal to 1.43. PEG ratio of 1.43 is still relatively high. It's not as inflated as Apple's PE ratio might suggest, considering its explosive growth potential. Thirdly, we look at Coca-Cola. Coke's PE ratio is around 20 with a growth rate of around 5%. Dividing the PE ratio by the growth rate, 20 divided by 5 is equal to 4. Like Apple, Coca-Cola's PEG ratio suggests that a stock might be somewhat expensive on its modest growth expectations, but its stability and reliable dividend payments make it an attractive investment for conservative investors. PEG ratio takeaways. So, as you can see, the PEG ratio allows us to compare companies more fairly by factoring in growth expectations. While a lower PEG is often seen as more attractive, it's important to consider the overall context and the industry a company operates in. Finally, to sum it up, the PE ratio helps you assess how much investors are willing to pay for each dollar of earnings, with examples from Apple, Tesla, and Coca-Cola showing how industry expectations can impact valuations. On the other hand, the PEG ratio refines the PE ratio by factoring in earnings growth, helping you understand whether a stock is fairly valued given its future growth potential. Finally, note, as an investor, it's important to use these ratios in combination with other financial metrics and industry comparisons to get a well-rounded view of a company's health and potential. Thank you for tuning into today's episode. If you found this podcast helpful, please subscribe, rate, and share the podcast with your friends. Thank you.